Ladies and gentlemen, good day and welcome to the Q3 FY22 earnings conference call of India Grid Trust, hosted by JM Financial. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Subhadeep Mitra from JM Financial. Thank you, and over to you, sir.
Thank you. Good afternoon, friends. On behalf of JM Financial, welcoming you all to the third quarter FY22 earnings call for India Grid Trust. We are joined today by the senior management team led by Mr. Harsh Shah, Chief Executive Officer, Mr. Satish Talmale, Chief Operating Officer, Mr. Jyoti Agarwal, Chief Financial Officer, and Ms. Meghna Pandit, Chief Investment Officer. I would now request Harsh to begin with his opening comments, followed by the Q&A session. Over to you, Harsh.
Thank you. Thank you for having us, and thank you everyone for joining the quarterly call. I will take through the presentation as it is available on the exchanges in the same presentation, and I'll have my colleagues Jyoti, Meghna, and others to talk about certain parts of the business, and we will go for the question and answer session after that. To start with, I have a slide number 3, where our vision is stated. Our vision remains to become the most admired yield vehicle nation. And we believe we can achieve that if we are focused on the below 4 pillars, which is a focused business model with long-term contracting, low operating risk, value accretive growth, BP accretive acquisitions, and creating future growth pipeline, predictable distribution, which we are guiding towards in quarterly consistently provided distributions, and following an optimal capital structure, consolidated leverage cap, and then keeping the platform well balanced. Next is on slide number 5, just as a snapshot of what we are. We are India's first power transmission yield platform and also one of the largest power yield platform in India. We have about 21,000 crores of assets under management across most states in India, about 7,500 circuit kilometers, and 4,500 MVA substation capacity. Our projects are secure in nature, and we have a resilient contract life of about 3 years in terms of predictable revenue. Going towards the next update on the quarter 3 FY22 performance, I think the first thing I'll talk about is the sector trends. And I believe we discussed this earlier, but our sector is becoming exciting, I would say, by the day with the developments that are happening in India as well as across the world. And one can put in, as we put it into 3 buckets, is the technological disruptions that are happening, shifting of demand patterns, and regulatory dynamism. To talk about how the demand patterns are shifting, I think we have been listening to and following how the peak demand has been growing on a consistent basis in the country. And much beyond that as well, we see that government narrative has changed. In the past 5 years ago, we would have heard about providing electricity or making electricity reach rural India. But with the current programs that have been effective over the last 5-7 years, the narrative has moved towards the reliable electricity as the focus, because as such, electricity has reached substantial part of the country, but reliable electricity has become the focus. What that says is that we are going to see more and more consumption growth happening in the sector. Beyond that, I think if one takes a 10-year trend, EV is certainly a game changer, especially for a country like India, which imports its fuel essentially and has a geopolitical implication of being import dependent. If India can make a transition to an EV economy, we believe the consumption is going to be substantially higher than what we are predicting right now and on the curve. Certainly, there are challenges it's too early, but if one takes a 10-year view, we believe he is the solar was maybe 10 to 15 years ago. And therefore, we are positive about the growth in the sector per se in terms of just electricity consumption. The second part of it is technological disruption, which is to do with reduction in cost of renewable energy and storage technologies. And why is that important? Is because the variable cost remains to be minimal for these energies, and if the capex costs have reduced, which it has, we see tremendous amount of benefit to the country. And as we know, we are one of the largest in the world in terms of incremental installed capacity with respect to solar. And we believe that this ecosystem will grow and further cost would support, and then sector would, become a self-serving sector in few years to come. And the last one is about the regulatory dynamism, and then one can also do it with transmission, because eventually what we need is a GNA, which is General Network Access Rules, which is the draft rules that are announced recently. We believe that is something which will enable the country to tap in the cheapest power from the cheapest location. It should require tremendous amount of investment in transmission. Second is de-licensing of distribution. I think while it's not been a huge success in terms of execution, but at least directionally, the plans, the policy has been moving in the right direction to resolve the customer side issues in respect to payment, which is the core of the challenge to the sector today. We believe with these three things moving in tandem, we are looking at a decadal growth in the sector. And with the involvement of technology and new age investments, we are really hoping that it is not going to remain an industrial sector and we move towards a technology-based sector. Coming to our quarterly results, our quarterly results have been robust, and the highlights have been that EBITDA grew at 32% year-on-year, and BP increased by 3% year-on-year. Last year we did 3.1, now we are distributing 3.19 as a run rate. Quarterly collection, very healthy, and we collected 103% in quarter 3 FY22, which is in line with general seasonal collection trend. One more important update is that KKR and its entity has acquired 26% residual stake in Individual Investment Managers Limited from Sterlite Power, which means that KKR owns 100% of the investment manager and also is the sponsor of IndiGrid. And Sterlite Power owns residual shares in IndiGrid as well as Individual Investment Managers Limited. Coming to the next highlight of the business is we are maintaining a well-capitalized balance sheet. Our net debt to AUM remains at about 56% versus the cap of 70% by SEBI, and we believe we have sufficient headroom to acquire assets as and when they are available. And we will continue to maintain a well-capitalized balance sheet to see through any uncertainty or volatility one can see in the macroeconomic scenario.
Sorry to interrupt you, Mr. Shah. May I request you to please speak a little louder, sir?
Sure. Okay. Thank you.
Thank you so much.
Coming to the third part of the chain, which is resilient asset management, which has been our focus at the beginning. Average availability is at 29.53 for this quarter, which is lower than the maximum availability. However, in this quarter, we have taken a lot more reliability-related shutdowns, and that is why the availability is usually down. However, on a year-to-date basis, we are doing as per plan, and therefore on maximizing our incentive. Digital asset management initiative, DigiGrid, that we spoke about a few quarters ago, where we are implementing this as a digital tool with IBM. We have implemented across 8 SPVs, and balance we are expecting by this fiscal end, which means we will move to a completely digital way of asset management by the end of this financial year. We acquired an ERS, it's called Emergency Restoration System, this year, and we have deployed it across different parts of the country, as well as trained our team members to be able to restore the lines in case any untoward incident was to happen. With respect to our CSR projects across the portfolio, we are following the themes of promoting education, healthcare, rural development projects, and also in a big way, green initiatives. The last one is a strategic decision that we took in the last quarter, where we won a first TBCB bid to evacuate power from RE projects in Maharashtra on a big basis. It's about 16.7 crores of levelized tariff. It's relatively small, and however, it just allows us to exhibit our execution capability and create an organic growth pipeline for the platform. We believe that such organic growth opportunity, by channelizing our excess NDCF and reserves, plus using our debt saving capacity, would be able to create a compounding of 10% of additional cash flow available by channeling this towards the development side of the business. We intend to keep it limited in size. However, we intend to grow this eventually to ensure that we create an organic growth pipeline. On the next part of the presentation is about the operation highlights of the quarter. I would like to invite Satish Talmale, who is Chief Operating Officer of IndiGrid, to take through that slide.
Sure. Thanks, Harsh. So would like to share the operating performance for the quarter. So on availability performance, we achieved 99.53. Again, this is a consistent performance quarter over quarter, and then we will always have an effort to improve it better. But as Harsh has rightly said, we planned a couple of scheduled outages to take care of few annual shutdown activities in this quarter. On reliability, again, in the previous quarter, you might have noticed that the indicator was same at 0.10, which means how many number of trips happened across the portfolio. So we are consistently maintaining. So looks like we are stabilizing here, and again, efforts will be put to improve it at next level. But this is the best in class record reliability index what we are monitoring for the asset. Digital asset management platform, it has gone live for 8 assets and seamlessly got implemented for these 8 assets. And by end of March, I think we are going to complete all the assets in the portfolio to manage all our day-to-day operating activities in a digital manner. Emergency preparedness, ERS has been already inducted, and teams have been trained to take care of any such emergency event. So now there is a huge amount of confidence in case any force majeure kind of events happen, we'll be able to restore the system as per within the time limits as advised by regulation. On EHS, again, as a culture, very proactive reporting and closure of timely unsets at time conditions have been continued. We had very minor 2 injuries in the portfolio in Q3, and those have been mitigated quickly, and a lot of corrective actions and preventive actions are being planned around that. But the focus on zero harm is being continued. Just a quick bite of COVID, as we all know, at Q3, we had a lot of stringent restrictions, the way the operations has to be carried out with respect to the number of people. A lot of outages were planned, but all the outages were carried out very safely without any much larger COVID impact. All the business continuity like substation operations, which happens 24/7, continued, and there was no any impact on COVID issues. In the last, I think, we do have 100 megawatt solar power plant, so that has also, delivered the generation as not expected because of bit of cloud cover and local events in that area. But I'm very hopeful that we will catch up in the coming quarter on the solar performance. Yeah. That's it, Harsh. Back to you.
Thank you, Satish. And as we go for the financial performance, JP, would you please take the lead on that?
Thanks, Harsh. I'll take you through the financial performance for the quarter. So in this quarter, we clocked revenues of about 571 crores and EBITDA of about 518 crores. So these were a healthy 32% higher compared to corresponding quarters of the last year on the back of acquisitions that happened during the intervening period. We also generated an NDCF of about 259 crores, which was 17% higher on a year-on-year basis. And as already mentioned by Harsh, we are in line with our guided DPU of 3.1875, and the board has declared that for the quarter, which is higher than the corresponding quarter of last year by 3%. If you take a slightly longer term trend of the last 4 and 5 years, then we do, demonstrate a very healthy revenue as well as EBITDA growth of more than 50% over that period. This is largely on account of, very value accretive acquisitions that we have done over this period, and this trend hopefully will continue going forward. The collection trend for the quarter has also been in line with expectation. Collections are at 103%. And while this is slightly lesser than the corresponding quarter of last year, on a basis, the collections are very much in line with what happened in FY21. Our DSO days are actually better than last year at 54 days this year compared to 70 days at the corresponding period of the last year. Now I'll move to the distribution update. As already mentioned, the board has declared a distribution of 3.1875, which is in line with our DPU guidance for FY22 of 12.75 per unit for the year. The breakup of this distribution is it comprises of 2 points and 52 paisa as capital repayment. The record date for this distribution will be February the 2nd, and the tentative timeline for distribution will be around the 11th of February. The NAV for the quarter is a little bit higher than 132 rupees at 132.53 paisa. Including this quarter's distribution, IndiGrid has distributed in excess of 55 rupees a unit, amounting to more than 2,700 crores of money to investors since listing. And based on current visibility, we should be in line for a quarterly DPU run rate in line with our 3 or 4% year-on-year growth. I move forward to the bridge between EBITDA and NDCF. So we did a EBITDA this quarter of about 520 crores. Adjusted for the finance cost at the SPV level, marginal debt repayment, some working capital movement and capex and tax, this translated to an NDCF at the SPV level for an amount of about 400 crores. Adjusting this for the expenses at IGT, finance cost and tax, the gross NDCF generated, which is available for distribution in this quarter, at the trust level is 259 crores. And we are distributing 223.2 crores as guided for this particular quarter, leaving a reserve of about 35.4 crores to be added to the existing NDCF reserve. Post this addition, our NDCF reserve would stand at about 152 crores. And given that there's 1 quarter remaining, we are well in line to meet, if not exceed, the reserve amount that we started the year with. You might remember we started the year with a reserve of about 170 crores. We are already at 152 with 1 quarter to go. So we should, based on current visibility, exceed the opening reserve at the end of this financial year. We'll move to the next slide, which talks about our balance sheet composition. I mean, we do have a very robust balance sheet, AAA rated, well-diversified debt book between the capital markets as well as the loans, and in each of these constituents, well-diversified between the various players. 76% of our borrowings are fixed rate, so we're sort of very much immune to any interest rate risks that might be there out in the market. The marginal cost of debt for us in this quarter was 7%, and this is well below the average cost of debt of 7.81% at the end of the quarter. And given the marginal cost continues to be lower than the average cost, there is sufficient headroom to see a further declining average cost curve for the coming few quarters. If you look at the repayment profile, we've been able to extend the repayment profile quite a lot, as well as even it out. and it's well within 1,500 crores for each of the years, other than FY23, which is higher for legacy reasons. But here again, out of the 2,400 crores which is coming for repayment, we've been able to tie up already through an advanced loan facility almost 650 crores. Almost 45% is already tied up at very attractive rates. And for the balance, we are at very proactive as well as advanced discussions with a variety of lenders, both in capital markets as well as on the loans, and see no challenge to be able to refinance this particular amount at rates which would be sufficiently lower, significantly lower than the legacy rate at which these loans are being carried. Now I'll hand it over to Meghna to take through the next part of the presentation.
Sure. Thanks, Rafi. I'm on slide number 14. Culmination of all our efforts in terms of acquisitions and robust asset management, we can see we've been delivering consistently superior risk-adjusted total returns. Our total returns here comprise of distribution, that is already 55 rupees per unit over the last 19 quarters, and the price change of about 58%, which leads to a total return of 114% since the time we listed in June 2017. On an annualized basis, it translates to 18%. This, if we compare with pure debt instruments of GSEC bond 10-year as well as 30-year, you can see IndiGrid has outperformed. And at the same time, if we compare it with pure equity portfolios like NSE Infra Index, BSE Utilities, or even individual stocks within transmission sector, you can see that IndiGrid has significantly outperformed. An important metric to also look at is the beta, which provides what is the volatility that the stock has vis-a-vis the market. And you can see that IndiGrid's beta is amongst the lowest, 0.05, which translates into a very significantly superior risk-adjusted return for the investors. Moving ahead, as we look to FY22, the last quarter, our pillars of focusing on portfolio growth continues. We are seeing significant pipeline getting added with respect to the bids which are coming up. Already 400 billion worth of tenders have been notified by CEA. In addition, all of us are aware about the national monetization pipeline, which talks of almost around 450 billion worth of transmission assets likely to be monetized. In addition to that, on the Kalam Transmission Limited, which is the recently greenfield asset that we acquired, we are focusing on timely execution over the next 15 to 18 months. The last of the framework assets, Khargone Transmission Limited, has also achieved COD in December. So we are looking to acquire that project as well from Sterlite Power, in addition to other operational solar and transmission assets. Jyoti already mentioned we are very much looking to cover the DPO guidance of 12.75 SA for FY22, including the fourth quarter. On the balance sheet part, the refinancing opportunities in FY23 and otherwise, we are proactively looking to elongate tenures as well as reduce the interest cost and are comfortably placed there, in addition to maintaining adequate liquidity measures in place. On asset management side, our focus on maintaining more than 99.5% availability continues to be there, with focusing on certain self-reliant O&M practices. DigiGrid, we've already spread across 8 assets. We are looking to cover that across all our portfolio by end of this fiscal, and at the same time ensuring world-class EHS and ESG practices. On the policy advocacy front, we've seen reduction in lot size. We have seen expansion of our debt sources. In addition to that, we are now also working on certain policy initiatives to remove the tax anomalies between equity and InvITs in terms of holding periods for capital gains, or also including InvITs and REITs as part of various indices. So we are working with the exchanges and SEBI on that matter. All in all, essentially our focus remains on providing superior total returns and at the same time maintaining the sustainable growth in DPU without losing focus on operations per se. With that, we close the presentation, and I think I would hand open for question and answer session, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Swarnim Maheshwari from Edelweiss. Please go ahead.
Yeah, hello. Hi. Thanks for the opportunity and congratulations for a decent performance. My first question is for Jyoti. So, Jyoti, if you see, there has been a very sharp spike in the 10-year GSEC and then interest rates are likely to go up. So, I mean, do we still expect our blended cost of debt to come down from current 7.9%, or do we expect some sort of reversal over the next quarters?
Yeah, so good question, Swarnim. You're right. I think the interest rate environment is towards the hardening side. But given that there is a sufficient headroom available in terms of our marginal cost of debt being significantly lower than the average cost, we still feel that we will have headroom to lower our average cost of debt over the next 2 or 3 quarters. You must also remember that the debt which is coming for refinancing is not at the average cost but at significantly higher rate because they were locked in at a time when interest rates were in a very different trajectory.
Yes.
So if you look at the net delta, the rate with that we are refinancing, of the existing rate at which the debt is getting refinanced versus the new rate at which we are borrowing, there's a significant delta. Just to give you an example, there is a 1,400 crore NCD facility due in June this year, which was locked in at 9.1%. It's all public news, right? Our marginal cost this quarter is at 7%. So even if you, let's say, see a little bit of headwind, it goes up by, a few basis points. Still, there is significant room to continue to sort of optimize on the average cost of debt. So to answer your question, we would have been able to do a much lower rate of financing if the interest rate environment was more benign. But nevertheless, even with a slightly more adverse environment, there is sufficient headroom to continue to reduce our average cost of borrowing over the next 3 or 4 quarters.
Got it. No, that's clear. Right. Thank you. Secondly, we have already forayed into acquisition. We have already forayed into the greenfield transmission assets now. So, what is really the benchmark for us that we would be targeting? What should be the percentage of, AUM for this under construction assets as a percentage of the overall AUM? Do we have any kind of benchmark? So as can this be about 5% of the overall AUM under construction?
Yeah. So Swarnim, I think, I think we are looking at it as I would say a strategic thought. And we have a percentage in mind at this point in time. As you already know, SEBI has put in a cap of 10%. That is going to be a maximum percentage that we can reach at any point in time. However, I think our plan is to focus on few principles, right? One is that there are certain projects that we like because of the risk return for that project. So certain risks are lesser and we feel they are digestible to us. And if the returns are interesting, we will go for that. Now, if it means that there is a very good opportunity which allows us to do a low risk project at a better return, yes, we may reach 5% or even cross 5%. But on the other hand, if we see that there are no such opportunities available, we remain at 1% what we are today. So even 5% is a sizable number for us today. 5% would mean around 1,200 crores of overall development AUM. So at this point in time, we don't have a goal to reach out. We are looking at it incrementally. If we find opportunities which are interesting, we will go for it. And if we think it is not worth pursuing, we will not go for it. It will remain at such a low percentage. So we are looking at it in an opportunistic manner, but also strategic because we want to develop assets and prove the capability that we can do it, right? And that's how the first asset is done. But opportunistically, we look for only assets which make sense to us in terms of return.
Right, Harsh. And just yeah, sorry. Sorry, am I audible?
Yeah.
And one just last question. So when we had acquired FRV, the valuation framework was very different, and I think over the last 12 months or so, the valuation framework for renewables had changed. So do you see that, any kind of acquisitions at the current valuations that the renewables are, that would be value accretive for us, and are we still searching aggressively for renewable assets? That's it from my side. Thank you.
Okay. Good, thanks. So I'll just address the last part. We are never searching aggressively for business, actually. We are not an aggressive company. We are not an aggressive entity. I think our focus is to do the right capital allocation and play the capital cycle in a efficient way with the right vision. So we were never searching aggressively for assets. Having said so, I think your assessment is right. In renewable space, especially in solar, our view is that the valuations at which certain transactions are happening are, I would say, expensive, and we keep looking at assets, but if the valuation don't stack up, we are happy to walk away. For example, 2 years ago, we decided we will do solar. We acquired FRD a year before. And since then, we have not found valuations to be attractive, and we are okay with it, right? If you don't find the assets at the right value, as I just said, for development, we are okay not acquiring it, because we do not have a rigid policy number on a particular percentage over there, and I don't think it is prudent to have so. And you can see on the borrowing side, we are well diversified, and that means we want to maintain a healthy mix between capital market instruments, which provide long-term fixed rates, and banks, which has a restriction of, I would say, fixing rate for a longer period of time, but on the other hand, they make capital available for a really long period of time, like 15 years, 17 years. So we strike a balance between the two. And then today also, I would presume we are about 76% fixed rate borrowing, which is sizable, and 20% is floating rate borrowing, which is largely from banks, which is really a long-term capital and substantial cheaper capital as well today. So there is always a lag between if the interest rate is moving up and down with respect to bank cost of borrowing. And we believe that 25% floating rate is a healthy mix, because see, this, when we say floating, doesn't mean it is short-term. It is a long-term capital at a floating rate. And there is a tremendous value in having long-term capital, even if it's floating rate, because that ensures that you are less prone to shocks in the capital market. Because capital market, the way the depth is in India, you can face for a quarter, I think sometimes substantial amount of liquidity crunch and shocks in a difficult time. Whereas on the bank side is a far deeper and stable market. So it is a healthy balance that we maintain, and our focus is more on maintaining a balance at the balance sheet level for risk management rather than optimizing cost for a particular type of borrowing.
Understood. Thank you. Thank you, and all the best.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1. The next question is from the line of Subhadip Mitra from GM Financial. Please go ahead.
Thank you. Harsh, I had a question with regarding to the TBCB landscape. So we keep hearing about, a new surge in TBCB related ordering that is going to happen, and we hear of, TBCB pipeline being, as high as 24,000 crores in the current year. Just wanted to understand, your perspective of how you see this resurgence in transmission capex, and do you see this kind of trajectory continuing for, 2 to 3 years?
Sure. So I think my outlook is that the transmission market, again, it's not a year-on-year market. Every 3 years, what happens is 1 year there is a peak ordering of 50,000 crores. Other years there is a gap, and suddenly there is a mid-year of 20,000-25,000. So it works it doesn't work in a linear fashion, unfortunately. So one needs to take a 2 to 4 year outlook of this. I think current year is great because, I mean, as you rightly put, there is 24,000 crores of tender that we clearly see, which is, I wouldn't say a phenomenal year, but a decent year in terms of pipeline for a number of players that are there. And I think even for FY24 and FY25, I think this momentum will continue. I don't know suddenly if there is a 50,000 crore plan or not, but this momentum will surely continue. And the directional inputs that we see is that Ministry of Power is incrementally reducing the layers which were delaying some of the bids to come out, right? So there were 2 layers at NCT earlier. Now there is just 1 layer of committee and all that. So that will make the process faster. In addition to that, GNA draft is out, and if GNA wants to become a success, right? If the ministry wants to make GNA a success, which clearly they want to, GNA can only succeed if there is more investment in transmission, because there is no other way. GNA is like just to have more transmission so that we can evacuate power more efficiently. So clearly, at the policy level, the direction is to make GNA work, which is the right decision. And to make GNA work, there is going to be investment in transmission which will be required. And I think all the power sector planners understand that very well. And therefore, maybe for a 1 year, there can be a lag that, bureaucracy and tender pipeline may take time to come in, but it will catch up in the next year. So eventually, if you take a 3-year horizon, I'm pretty optimistic of the number of bids that will come out to bid. And in addition to that, for player like IndiGrid, we also are looking actively at the state monetization routes. So we are seeing after NMP tremendous amount of impetus from Ministry of Power to state to look at monetizing their state transmission assets as well, which, to be honest, is a very, very large market. However, we don't know when that will come out specifically. However, the interest, the committees are formed. CEA is looking into it. There has been a lot of debates and discussion with private sector guys as well. So the intent is in the right place. And if the intent is in the right place, I don't see why should there not be an Odisha-like auction that happens in distribution in transmission as well. So we are pretty optimistic on that part, which will come in large chunks. So for us, we have a wider set of target businesses as well to look at.
Thanks, Harsh. This was really helpful. Lastly, also, we hear of PGCIL coming to the market, to also offload their TBCG projects. I think the number that they're touting is every year you look at 10 to 15,000 crores. Can that also potentially be, a market for us?
Sorry, can you repeat that?
What I meant is Power Grid's TBCB assets, as they mature, they are also looking at offloading those into an InvIT platform. And as I understand that the PG InvIT doesn't have a ROFR. So is that a potential market that you can look at?
Oh, certainly. We will be looking at that. And I hope that Government of India runs a transparent bidding process as it should be run, because at the end of the day, Power Grid is owned by taxpayers' money. And for a government-owned assets, it is important that an international transparent bidding process is run. And if the transparent international bidding process is run, they would be very active and happy to compete for this asset.
Understood. Thank you. Thank you so much.
Thank you. The next question is from the line of Kayur Ashar from PNB MetLife. Please go ahead.
Yeah, congratulations, Harsh and team, for a good set of numbers. And thank you for the opportunity. So I have a couple of questions. So just on the foray into greenfield solar, if you could talk about our internal capabilities in executing this and what kind of IRR are we looking at in this particular segment?
Okay. So the internal capabilities question is we have a substantial amount of capability internally, and I think between the leadership team, many of us are the people who built some of the assets that we have acquired from Sterlite as well. And also many of us are also people who built the asset and were continuing to doing O&M at an operating level. So we have teams which have built thousands of kilometers of lines, designed them, built them on their own, etc., in their earlier roles. So in terms of people capability, we have substantial amount of capabilities in-house to develop assets. We also have a separate vertical within the company to ensure that our basic O&M practices are not, or rather O&M function is not mixed with the construction team. So that's a separate development teams that are built in the company. We have sufficient capabilities on the front of development side of the business. On the IRRs, I think we look anywhere, as you said, we avoid giving specific numbers, but we look at least a couple of hundred bits higher than operating projects IRR in a development stage. But again, it depends. If it is a risky project, we would like to do higher return projects, but we don't plan to do risky projects in integrate. So about 200 to 300 bits higher than optimal IRR is something that we look at.
Sure. Thank you. This was helpful. And secondly, on the availability performance this quarter, specifically on the outages seen in one of the assets, that is MER, can you help us understand the impact of this on the financials? So I understand there are penalties involved if the availability goes below 98%. So some light on that?
Sure. So there is actually not material impact on the financials on account of this, because the incentives and penalty are on a cumulative basis typically. And while we are presenting a quarter 3 number, at the end of the day, we are in a capital allocation business and capital cycle will turn around. And we are seeing part of it playing out in the monetary cycle and the cost of interest cycle as well. So eventually we feel sanity will prevail if one is able to take a 5-year view. And fortunately, as a scale, as well as the stable business that we have in transmission, we are not in a hurry and we can take a 5-year view and say, let's wait for a cycle for a year, when the cycle is around, consolidation will start, and we may look at assets which are available at a better price than we have now. So we are happy to wait. But to address the question, yes, asset prices have inflated substantially in solar, and we haven't seen something interesting that, and that's the reason we have not acquired anything yet.
Fair enough, Harsh. Thank you so much and wish you all the best. Thank you.
Thank you.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good afternoon, Harsh, and congratulations for another steady quarter. So first question is, for your DPU growth as such, one of the levers is reduction in the cost of fund. But in the absence of that, given the commentary on solar assets anyways, where we may not find any interesting assets for a while, and somewhat slower execution in terms of the newer sort of greenfield project, because that is fraught with risk and we have just started it and the percentage allocation would be lower. So where do you see any other lever for DPU growth going forward apart from these, because it looks like an environment where we cannot increase the AUM much. So that is question number one. Second is more of a long-term question. Have you done any analysis on, let's say, EV adoption in India rises to a particular level, let's say 30 or 40%? And in that case, what kind of electricity demand and hence what kind of additional transmission capacity will be required? And do you see any action on the ground towards that which may help us being larger? Do you see any additional investments being made to come up to that? First of all, one needs to understand that the delta itself because of EV adoption is going to be large. So that's why the first part of that question. And secondly, do you see anything related to that on the ground?
Sure. Cool. So I'll take your first question first. I think today we are distributing approximately we are distributing 12.75 rupees a unit, which comes to around 892 crores of close to 900 crores of NDCF on a year-on-year basis. Our 3% growth on that is what we are looking for, and what we have done in the past is about 30 odd crores of NDCF growth, right? If you look at our YTD NDCF, we are substantially higher than the 3.2 rupees growth that we are promising, and that's one of the reasons that our reserve itself today is about 150 odd crores. And if we continue with this run rate and collections work out well, reserve will be substantially higher at the end of the financial year. So this enables us to, or rather, let me reverse it. We can increase DPU this year itself if we wish to do it just based on the current assets. We are not dependent on new assets necessarily to increase the DPU. I mean, the assets that we have already is sufficient to provide for DPU growth. So we don't need to worry about as a business that what if we don't acquire new assets this year, how will the DPU growth take place? And that strategy from IndiGrid side, that we do not look at the business in a 1 year horizon, we look at the business in a longer horizon, which enables us to take long-term decisions. For example, as I said, if the assets are not interesting, we don't buy assets for 1 year, we still have a sizable DPU that we have earned over the last few years and provide DPU growth still based on the growth that we have already. So the cycles are longer in infrastructure, and one should look at every year acquisitions to result in every year DPU. Or look at that whatever we acquire at the right time provide DPU growth for a significant period of time. So that's one. Second, as Jyoti answered, our marginal cost of borrowing is still substantially lower than our average cost of borrowing. Because our FY23, there is about 2,400 crores of refinancing taking place in FY23, which is at least 150 basis points more expensive than our incremental cost of borrowing, right? So even if we were to execute just a 2,400 crore refinancing, that is going to result into 3-4% of DPU growth here and now for FY20, theoretically. In addition, we are insulated from interest rate increase to some extent because our FY24, 25, 26 repayment are substantially lower, as you can see. So even if the interest cost was to go up from here, we are still talking about less than 10% of our cost of borrowing going up here. Right? So we have a balance sheet which is interest rate resilient today, even if the cost was to go up in, let's say, 3 years time frame, any year on year. And we have a shorter term opportunity to refinance 2,400 crores, which is going to result into a substantial NDCF accretion. So your hypothesis that interest rates are going up that will result into lack of NDCF is incorrect, because we are in the other side of the curve, that DPU growth itself might happen from interest rate reduction because those interest rates that we are refinancing are higher cost capital structures, and we are getting into a much lower cost in relation to that. And the third is we still have substantial headroom for acquisition. Right? So we are today at 56%, and if we want to go to 70%, we can still acquire assets worth 5,000-6,000 crores at a substantially cheaper incremental cost of capital, which will give us a sizable growth. Now, at what IRR do we acquire, what is the asset, is the decision that we make depending on type of assets and what is available. But as I said, we are not dependent on a particular asset to acquire or something to happen to provide DPU growth. Like we have sufficient reserves based on the current assets, which creates a waiting capacity for the right time. In addition to that, we clearly see the next 2,400 crore yielding NDCF bump because we are refinancing higher cost debt with a substantially cheaper cost of debt. So we are kind of conveniently placed on that. On the second question on EV, I think we have not done any studies, but see, it is a vision, to be honest. Directionally, we don't know how much EV adoption will happen. The key driver remains the cost of vehicles coming down, right? And that has nothing to do with electricity. Electricity costs are substantially cheaper to make it viable. But the cost of batteries and cost of vehicles coming down is manufacturing play. And while the government push is remaining, when the government push is there, we need to wait and watch if cost of vehicles come down materially to reach a 30-40% penetration. But let's say, 30-40% is phenomenal. If we were to reach a 30-40% penetration, imagine a 20-30% oil and gas sector getting added to electricity sector in terms of value, right? So that is the size we are talking. And if that much of size is getting transferred to electricity sector, then about 10% of that investment will come from transmission, more or less, right? So that is the very high-level rule of thumb one can look at. But we haven't done a specific study around that. And we feel it would take at least 5 years, if not 10, to really reach that 30-40% penetration.
Understood. Just one more follow-up. So I think the percentage of our borrowing which is coming through fixed rate debt, has that figure become lower than what it was a couple of years back? And is there any policy or a rule at the board level that we will not come below a certain number because our revenues are fixed? So how do you manage that risk, and has that number come down?
Yeah. So the cumulative number from quarter 1 to quarter 3 is decent. So we are not really impacted materially by this. So there are very limited financial impact in single digit or other very small amount. Like real impact doesn't impact us in a material way. And some of the issues that we have seen as a post outage, we are also looking to recover from insurance. So we, to be honest, feel that it will be kind of a very, very small impact on the revenue.
Understood. Yeah. And lastly, any expected timeline on KTL that you would want to guide?
Okay, so KTL is commissioned, and that's what we understand. We will be following a framework process over there with Sterlite Power, and as per that, we will start the diligence soon. And once we do the diligence, we'll be able to communicate in a better way of where.
Okay, yeah, fair point. Yes, thanks, Harsh.
Thank you.
Thank you. The next question is from the line of Mitesh Shah, an individual investor. Please go ahead.
Hello, am I audible?
Sir, your voice is too low. Can you speak a little louder?
Yeah. Hope I'm audible.
Mr. Mitesh, we cannot hear you, sir.
Am I audible now? Hope I'm audible now.
Yes, this is better. Please go ahead.
Yeah. Congratulations to the management team on a good set of numbers. There is a 97% availability for NER transmission line. So I think it is also covered under insurance. So just any color on what can be the cash flow shortfall and by when generally it can be recovered. Second question is on basically, is there any disruption in this sector which from a long-term perspective which we should be looking at, for example, wireless electricity transmission or something on the those things.
Sure.
Like experimenting with that. And the question is that the integrated InvITs are not allowed to be pledged for margin. Other exchange traded instruments like shares of Reliance or mutual fund, etc., are allowed to be pledged as margin. So this is not yet done. I think in the last investor conference also this question was brought up. So if the management team can write to the exchanges, maybe to consider. Thank you.
Sure. Thank you. So, coming to your first question, we just address it, but as I said, it is a very, very little real impact, like single-digit crore impact. It's a very, very small impact on the P&L from anyhow, so we don't really see it as a larger impact. The second question on wireless, I think decades people have been talking about it. That transmission is driven by physics in terms of transmission of electricity and hasn't changed over the last 50, 60 years. Doesn't mean that it will not change, but I think the technology that can disrupt this is at a primitive stage, is what I believe. And I'll give you a parallel. We've heard about 5G rollout, right? And 5G rollout is nothing but a microwave in the air. And we have all heard about the environmental issue on the birds, issue on the flights in the latest discussions, right? Transmitting electricity in the air is going to be 1 million times more powerful waves in the air, right? Even at a proto stage that has been done. The same amount of energy, because energy has not changed. If you want to transfer 100 megawatt hour of energy, then it's that much of energy needs to transfer via waves in wireless, which will be kind of millions of times more heavier waves than 5G waves that we have been talking about. So I think the widespread use of wireless is done at a primitive stage in an extremely narrow, shorter distance manner. So we are not really worried about that kind of disruption in the sector today. The real disruption that people are thinking about on the ground is a microgrid, that you don't need transmission altogether, which is a business model disruption rather than technological disruption. But again, electricity is the cheapest form of transmitting power. So they will always be cheaper to produce electricity where fuel is best. So there will always be Rajasthan will be cheapest source to produce electricity and transmit it to the rest of the country. So the microgrids will coexist with the main highways or the main grids. But other than these, we don't see a material amount of disruption in the business per se on that front. There was a third question also. I actually missed the third question.
Hi, Meghana here. I think that was on the margin money that Mitesh asked.
Oh, yeah, sorry. Yeah. I think what we would request is, Mitesh, why don't you write to us? We see as a company or as an invest, we writing to exchanges and SEBI, we do not get the same kind of response because as a company can't say that allow our shares to be pledged, right? And so investors need to write to us. We are happy to forward those mails if we receive formal requests to SEBI and exchanges. InvIT standalone doesn't have a locus standi to go and say allow our shares or units to be pledged. It looks very awkward. So we'd request investors to write to us. That will enable us to write to exchanges that look, this is what our investors are looking for. Can you work around that? So we would request you to write to us.
Does that answer your question, Mr. Mitesh?
Yes, thank you.
Thank you. Participants, to ask a question, please press star and 1. The next question is from the line of Nimish from an individual investor. Please go ahead.
Hello.
Yeah.
Hello. Yeah. Congratulations, Mr. Shah, for the good number, and thank you for the opportunity for me to ask a question. I'm also from long-term investor point of view, just as a previous investor. Just wanted look for any attractions or pointers for investments or incentive at this market price, given that our right issue was at 110. What is the target AUM and target DPU in next maybe 2 to 3 years, FY24 or FY25? And any other attractions which you can incentivize the long-term investors? Thank you.
Thank you. So I will give you a very small answer on that. I think we as management cannot give incentives or cannot predict prices, right? It's not our role. But I can tell you, I think we have been guiding for a stable DPU, and if you look at our track record over the last 5 years, we have grown our DPU from quarterly 2.75 to 3.19, which is around 3% growth on a year-on-year basis. And as we have guided in the past also, whatever DPU we have forecasted for the year, we keep it in a way that it is a stable DPU for a long period of time. And then on an annual basis, we give a forecast of DPU growth at the last quarter. So we have provided for DPU growth guidance for FY22, and we are on track to achieve that over the last 3 quarters and so. For FY23, we will be giving guidance in quarter 4 or the full financial year results. However, I think, as we have said, our DPU of 3.1875 or 3.19 is a stable one for a consolidated item, so that will continue. And the growth guidance specifically will give in support, but we have been providing a stable growth over the last 5 years. So I think beyond that, it is inappropriate for me to guide on attractiveness or incentives for long-term investors. Right? One needs to make that decision on their own.
Yeah, and what is the target AUM, sir, for FY24, FY25 maybe?
We don't work on a target AUM basis. We work on, if you get a good business, we'll acquire. If you don't get, you still have a stable DPU to look for, right? So we are not really worried about it. We don't have target AUM even in our evaluation matrix, right? So we believe AUM as a target is not a right target when the key role is to do capital allocation. So we are just waiting for the good opportunity to acquire assets and build, but we don't have a specific target AUM for assets.
Okay. Thank you, sir. Thank you for giving the opportunity.
Thank you. The next question is from the line of Arpit from HSA. Please go ahead.
Thank you for the opportunity. And congratulations to the management team for a steady DPU this quarter again. So my question was with respect to the foreign greenfield. So given that in other projects we have seen delays for many TBCB projects to achieve COD, and finance cost is one of our levers to maintaining the DPU. So how do we mitigate this risk of project delays affecting the DPU going forward? I understand that this piece is very small currently, but I'm sure going forward it may increase.
Yeah. No, I think it's a very, very valid question. I think we keep evaluating this risk in a big way, and a tremendous amount of focus is provided for this. I think like any other our businesses, our strategy is measured and conservative. We choose projects which has relatively lesser inherent risk. So for example, the project that we have acquired right now, the Concall Transmission Limited, does not have forest clearance, does not have wildlife clearance, does not have railway clearance, does not have defense clearance, doesn't have environmental clearance. It had majority of substation-heavy project. It had a small land acquisition and a very small land. So we mitigate this risk by first choosing the projects which we feel are less risky. So it starts from our choice. Second point is that we have freedom to choose, right? Many of the businesses, I won't like to name, but many of the businesses are completely dependent on new bids to come in, and they have to bid every year. They have no option but to bid for all projects, right? And they cannot be as selective as we can be. And therefore, we have an advantage in terms of selecting the projects we want to bid and getting out of them. So we can bid for only 2 projects that we like and not bid for the other 8 which we feel are right. So that is an inherent advantage that we have. So we have first is choosing projects which are less risky and which do not have material amount of causes for those delays. Second is, as you rightly said, these are small projects, and even if we do more projects, it will remain small in the balance sheet. So the impact of those projects, if at all that was to get delayed by a quarter, is going to be limited on the overall balance sheet of the business. Right? So I think these two big principles we are keeping with us, which allows us to mitigate it, besides all the project-related, risk mitigation that we take. But these two are the strategic filters which allows us to remain conservative.
I just had a follow-up. Once this COD is achieved for the Kallam project, what would be the AUM that it would add to our portfolio? Would you be able to share that?
I can give you an estimate. I think it's going to be around 170 to 180 crores, something like that. It's a small size, yeah.
Thank you.
Thank you. The next question is from the line of Ravish Chandra, an individual investor. Please go ahead.
Yeah, thank you. Congratulations, Harsha and team, for the consistency in results, everything. I have two questions. One is I'd like to know what is the total percentage of our AUM today when you consider as a whole India? Are we at something like 25% of total assets, transmission lines we are having in India?
Okay. It's a very difficult question to answer, but I'll try to give it
approximate.
Yeah, approximate. See, there are two types of transmission assets: interstate transmission asset and intrastate transmission asset. The intrastate network is not well mapped, so I don't have a good estimate of that. But interstate assets, which is the TBCB portfolio and ISTS portfolio, which is the larger lines, we would be approximately 6 to 7% of the country today, approximately. And this we know because of our revenue weight in the overall pool. But that's what we are looking at, approximately 6%.
Okay. Yeah, I think we just want to know the exposure. See, I know Power Grid is going in a big way and getting into a lot of transmission lines. Now, maybe a very vague question.
Sorry to interrupt there. Power Grid is around 80-85% of the portfolio, not because they are doing more of incremental work. They have the legacy portfolio with them because they built 20 years exclusively, right? So that's why their share is always going to be very, very high in the overall thing.
Okay. Harsha, this is an academic question only. I don't know. Recently I read one article. Power Grid has taken some project internationally to build transmission line. Like that, in the future, down the line, maybe a decade later, whether IndiGrid also can do the similar activity in internationally because we get foreign revenue?
We haven't thought about it, but as on date, from SEBI regulations, we are prevented to do it. So we cannot do business outside India.
Okay. Because Power Grid is doing PPP participation in Africa, something on building transmission.
We don't plan to do it. We have not even thought about it, and in fact, we are not allowed legally. So
okay. Yeah, fine. The last point, what I observed in presentation slide number 19, I was under impression KKR and GIC put together is having around 54%. But in the slide it shows 44%. Maybe type error.
Oh, where do they own 54%? They own 44%. But where is it? Okay. So it mentions including KKR, yes. So the other way,
right.
Other FIIs.
Yes.
Other FIIs, like Schroders that you see below in the branch,
okay.
Schroders and others. So 11% are other FIIs.
Okay, fine. Yeah. Thank you. It's a good growth and congratulations for everybody to maintain the same and best wishes. Thanks.
Thank you.
Thank you. The next question is from the line of Mitesh Shah, an individual investor. Please go ahead. The next question is from the line of Mitesh Shah, an individual investor. Please go ahead. I'm sorry to interrupt you, Mr. Mitesh, but we cannot hear you, sir.
Yeah, hello. I hope I am audible now. I am
Yes.
just curious that, now that Sterlite KKR is the sole promoter for the sponsor, and now that Sterlite is not there, would there be any impact on bidding for Sterlite project, especially India they used to get first exchange or first right of refusal on many of the projects. So any color on that?
Yeah. So I think the first right of refusal of framework assets in Sterlite were not contingent upon sponsor or being manager. At the end of the day, we are all doing business, right? So why would somebody sell us cheaper if there is a better price available? And why would we pay somebody higher price if there is a cheaper asset available, right? So all transactions are typically arm's length pricing transactions. And if Sterlite decides to monetize, we would continue to participate. And I'm sure they will invite us because we executed this in a good way. And if Sterlite calls for a bid, we will certainly bid for it. So nothing changes from account of KKR being manager or sponsor. That is other, we have put together over 16,000 crores of transactions with Sterlite. So we understand how the business works. They understand how the business works. And if their view is to monetize assets, I'm sure we would be invited and we would love to participate in the bid.
Okay, that answers my question.
Thank you.
Thank you.
Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. Subhadip Mitra for closing comments.
Thank you. On behalf of JM Financial, I'd like to thank the management for giving us this opportunity to host the call. Harsh, any closing comments from your side?
No, thanks a lot, Subhadip, and very, very encouraged with the kind of questions investors have asked for, and I'm very happy because of the last 20 quarters of results, I think we started by explaining what InvIT is, and now we are talking about the real business questions, and I'm very, very encouraged with continued support of our investors and participation on the call. We look forward for all of you to continue to remain invested, and we would keep our focus on superior risk-adjusted return. So thank you for joining the call today and wishing you a great and healthy and safe time ahead. Thank you.
Thank you. On behalf of JM Financial, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.